Steve Leisman is standing by. He's got the numbers on that. Steve, take it away.
It looks like rose to 230. That is right in line, Becky, with the expectation. A slight revision last week, 226. But I'm interested, 4-week average also up to 230 now. It's been a little elevated, but the input has not been an issue. The issue has been the continuing claims. They rose to 1.67 million for the prior week. That's the week of November 26th, from 1.609. So that is a source, by the way, of the softness that people are talking about in the labor market, Becky, that you have this continuing claims going up. I'll tell you what the prior low was. I have it on the week of September 17th. It was 1.3. So there's roughly 300,000, a little bit more, 300,000 more people who are on continuing claims. And this may reflect the softness of some of the layoffs we've seen in the market. The question becomes, with the tightness still believed to be in the jobs market, are these people absorbed over time? You don't lose a job and get one right away. But the question becomes, when we want to gauge the tightness of the market, how long they remain on getting those job claims until they show up during the survey week as unemployed. It's something we have to monitor. A little bit of softness out there in the market that I think the Fed ultimately wants to see. With the big number yesterday, unit labor costs going down, something that Fed Chair Jay Powell mentioned. That number came in lower than expectations. It was responsible for yields declining. Back to you guys.
Steve, thank you. Let's get over to Rick Santelli, who joins us right now with more on this. Rick, we've been watching the market's reaction all morning. We have seen some improvement in the futures, at least. And part of it may be questions about what's happening with continuing claims, what's happening with the jobs market, and when all those layoffs we've heard about actually work their way into these numbers.
Yeah, no, and you've expressed the issue with layoffs on many occasions, Becky, that when we look at technology, when we look at many of the areas being affected, it isn't necessarily going to have enough leverage to do enough damage, I know this sounds crazy, to the jobs market to make the Fed happy. But with respect to the approaching of 1.7 million on continuing claims, that is the issue. Initial claims do seem more well-behaved, but the ongoing continuing claims ticking up will make the Fed happy. Doesn't make me happy. It doesn't make anybody who looks at policies and disagrees with the notion that you have to kneecap the economy to make it better in the long run. Counterintuitive to logic on the interest rate side to think we're doing this much work under 3.5% and a 10-year note at a time where you have past leaders of the Treasury, you have all the smart people saying, we're going to have to get up to 5.5 or 6% for the terminal rate. Long maturities aren't agreeing with the prognosis for the Fed or the short end of the market, and that is key, Becky. Back to you.